Hi, I'm Sharmila and welcome to my channel BD Business World, where people like you and me will go over different concepts of the business on a daily basis. In the last video, we started with the ABCs of the market, where we discussed about alpha. Today, we'll go over beta, why it is important and how it is used. So let's dive into the details of beta, the key to measuring investment risk. Have you ever wondered how investors measure the risk of a stock compared to the market? In today's video, we'll demystify the concept of beta, an essential tool in finance, and show how it impacts the investment decisions. Beta is a measurement of sensitivity of the asset's return to the movement of the market. It indicates level of systematic risk associated with the investment, essentially how volatile the stock is with respect to the market movement. In simpler words, we can say beta is a measure of how a stock's price moves relative to the overall market. Let's see how beta is used. In portfolio management, investors use beta to understand the risk-reward profile of their investments. By combining high and low beta stocks, investors can balance risk by diversifying the investments. Beta is also used to calculate the cost of equity through CAPM. We will go over the CAPM model and what it means to calculate the cost of equity in another video. Let's take a look at values of beta and what it means. Beta equal to 1 indicates that the stock moves in sync with the market. That is, consider an example of a Home Depot stock. Its beta is 1.01, which is greater than 1. If the market goes by 10%, the stock will be up by 10.1%, but which is almost same as 10%. So here we are considering its beta as almost equal to 1. Beta greater than 1 indicates that the stock amplifies market movements. For example, Nvidia has beta of 1.66. If the market goes up by 10%, Nvidia will go up by 16.66%. But if the market goes down, then the stock will go down by 16.66% and will have more losses. Hence, such stocks where beta value is greater than 1 are considered to be more volatile. If beta is less than 1, then stock mutes the market movement. If, for example, for Pfizer, the beta value is 0.62, where if the market moves by 10% in any direction, the stock will move by 6.2% in the same direction, which is less than 10% with which the market moved. Hence, it is supposed to be less volatile stock and also called as a defensive stock. Here, the numbers are too airy due to the current market, but overall, the pattern remains the same for given value ranges. Sometimes, assets also have negative beta value, which we'll go over next. Let's talk about negative beta. Rarely, a stock or an asset might have a negative beta, meaning it moves in the opposite direction of the market. An example of this is gold, which often rises when market falls. It can have negative beta when the stock market is going poorly, and due to this tendency, it acts as a hedge against inflation as well as recession. Hence, gold is called as a safe investment. Other examples are puts on stocks and selling forward contracts against indices that will have negative beta. For example, if a put option has a beta of 1.5, it will fall by 1.5% on a day that S&P 500 rose by 1%, and it would rise by 1.5% on the day when S&P 500 fell by 1%. Let's see why you should care about beta. First, it helps investors to align their investments with their risk tolerance. For example, a risk-averse investor might prefer low beta stocks, while a risk-tolerant one might lean toward high beta options. If you are risk takers, then you might already be having stocks with higher beta, and the opposite is the same if you are risk averse. So, why don't you go ahead and check out the average beta of your stocks in your portfolio and think about your own risk tolerance? You can find this beta information from Yahoo Finance or any other website providing financial data. Beta is a key input in calculating the expected return of a stock, which is nothing but alpha, and we discussed about the alpha in the last video. This expected return helps in making informed investment decisions. But remember, beta is not only the thing that you would consider while thinking about the risk. You should also consider the unsystematic risk which is related to the company. For example, lawsuits against the company, fraud, unethical practices, high debt, or it can also be mergers, acquisitions, competitive risk, and many more. Let's recap what we learned so far. Beta measures the stock's price's movement with respect to the market. Different values of beta indicates how the stock is going to move with respect to the market as indicated in the image here. So this is all about beta. Thank you for watching this video. I hope you liked it. If you found this explanation helpful, give this video a like, subscribe for more business insights, and let me know in the comments which financial or business concept you would like me to cover next. See you all soon in the next video. Until then, let's conquer the world.